Imagine waking up tomorrow and seeing headlines everywhere. A major bank has collapsed. People are rushing to withdraw their money. ATMs stop working. Online banking freezes. Long lines start forming outside bank branches. Suddenly, millions of people are asking the same question. What happens to your money when banks fail? Do you lose everything? Or is your money actually protected? To answer that question, we first need to understand something surprising about the banking system. Because banks don't actually work the way most people think they do. And once you understand how banks really operate, you'll understand why bank collapses happen and what really happens to your money when they do. The illusion of safety in banks. Banks feel safe. Your salary arrives there. Your savings sit in your account. Your balance appears stable in your banking app. Everything looks simple. Deposit money, store money, withdraw money when you need it. But the reality is very different. Banks are not vaults. They are financial intermediaries that constantly move money throughout the economy. When you deposit money in a bank, that money does not simply sit there. It becomes part of a much larger financial system built on lending, investment, and risk. And most of the time, that system works extremely well. But when confidence disappears, the system can suddenly become unstable. How banks actually use your money. Banks exist to lend money. When people deposit money, banks use those deposits to make loans. Mortgages help people buy homes. Business loans help companies grow. Credit cards allow consumers to spend before they earn. Car loans allow people to purchase vehicles. This constant flow of lending is one of the engines that drives economic growth. Without bank lending, modern economies would move much more slowly. But this system also creates a hidden vulnerability, because banks do not keep all deposited money available at all times. Instead, most of that money is already circulating in the economy. Fractional reserve banking. This system is known as fractional reserve banking. Banks are only required to keep a fraction of deposits as reserves. The rest can be loaned out. For example, if a bank receives $1,000 in deposits, it might only keep a small percentage available in liquid reserves. The remaining money is used to issue loans. Those loans then enter the economy where they're spent, deposited again, and loaned out again. This creates a multiplier effect that expands the money supply in stable conditions. This system works efficiently, but it depends on one critical factor: trust. Why bank runs start? A bank run begins when trust disappears. If enough people believe a bank might fail, they all try to withdraw their money at the same time. And when that happens, the bank cannot immediately provide all deposits, not because the money vanished, but because much of it was loaned out and is tied up in long-term investments. Once panic spreads, more and more people rush to withdraw their funds. Fear spreads faster than facts, and even healthy banks can collapse under the pressure of a bank run. History has shown this many times. Historical bank collapses, bank failures are not rare events in economic history. During the Great Depression in the 1930s, thousands of banks across the United States collapsed after waves of bank runs. More recently, during the 2008 financial crisis, several major financial institutions failed or required government intervention. And even in modern economies, smaller bank failures still occur from time to time. These events remind us that banks are part of a financial system that is constantly exposed to economic shocks, poor risk management, and sudden shifts in confidence. What actually happens to your deposits when a bank fails today? Depositors do not automatically lose all their money. Most developed countries have systems designed to protect bank deposits. In the United States, for example, deposits in insured banks are protected by the Federal Deposit Insurance Corporation, also known as the FDIC. Deposit insurance typically covers up to a certain limit per depositor. If a bank fails, insured deposits are usually transferred to another bank or returned to customers within a short period of time. This protection system was created specifically to prevent widespread panic in bank runs. But deposit insurance has limits. Limits of deposit insurance Deposit insurance does not cover unlimited amounts of money. Most countries set maximum coverage limits per account holder. If someone holds deposits above that limit in a single bank, the excess amount may not be fully protected. In extreme situations, recovering those funds can take time and may depend on the liquidation of the bank's remaining assets. For most individuals, deposit insurance provides strong protection, but for large deposits, the risk profile becomes more complex. What happens during systemic crises? Individual bank failures are one thing. A systemic financial crisis is another. When multiple banks face problems at the same time, governments and central banks often step in to stabilize the financial system. Central banks may provide emergency liquidity. Governments may guarantee deposits. Financial institutions may be merged, rescued, or reorganized. These interventions aim to prevent a collapse of confidence across the entire banking system because modern economies depend heavily on stable financial institutions. How people lose money in bank failures, even with deposit insurance and government protections. People can still lose money during bank failures. Large uninsured deposits can be exposed. Investors holding bank stocks can lose everything. Bondholders may face losses during restructuring. And during financial crises, asset values across the economy can fall. This means that even if deposits are protected, the broader financial system can still experience significant economic damage. How do you protect yourself? Understanding the banking system allows individuals to reduce their exposure to risk. Diversifying deposits across multiple institutions can help stay within insurance limits. Maintaining liquidity and emergency savings reduces dependence on any single financial institution. Paying attention to financial news and economic signals can help people understand when systemic risks may be increasing. And most importantly, understanding how the financial system works allows individuals to make more informed financial decisions. Why financial awareness matters. Most people interact with the financial system every day. They deposit money, they borrow money, they invest money. But very few people fully understand how the system actually works. Financial awareness does not eliminate risk, but it allows individuals to navigate the system with greater clarity and confidence. And in moments of economic uncertainty, that understanding becomes extremely valuable. Connection with the broader financial system. Bank stability is deeply connected to the broader economy. Interest rates, inflation, credit markets, and government policies all influence how banks operate.